So today we have a big, open, broad discussion about crypto. Crypto is having a resurgence at the moment. Bitcoin this morning is approaching record levels. So we're going to try to discuss an age-old topic, how to strike the balance between championing cryptocurrency innovation, but also having an adaptive regulatory environment and making sure that you're not taking too many risks. So Konstantinos, I'd like to start with you. So there's been a lot of activity with crypto regulation over the past few years after FTX, but the landscape remains quite fragmented. Obviously, Revolut is a global company. You're expanding everywhere. You're growing very quickly. How do you manage in your seat? How do you manage the risks of fragmented regulation, but also trying to protect your consumers while also trying to always be innovative, which is what sort of Revolut is known for?
It's a great question, and it's difficult. There's no doubt of that. We observe that obviously there are themes where regulation converges around the world. However, there is a lot of fragmentation still. It's a nation market, so regulators are still figuring out how to best approach it around the world. I think the European approach at the moment is the most comprehensive framework we have to date. But even there, we observe a lot of fragmentation still. We have fragmentation when it comes to money laundering standards, for example. And this poses real risks for, first of all, regulatory arbitrage, which, of course, it's not conducive to market efficiency, market integrity, but also poses risks for consumers. And we've seen this in the past. We've seen global operators choosing the path of least resistance and establishing presence in offshore jurisdictions and offering services on a cross-border basis in Europe, in the UK, in the US. So I think it's important to set global standards. Obviously, we're very, very far away from having a common global standard, but FATF recommendations, as an example, are a great starting point. And it's also about the industry making sure that it follows high standards.
So, Usman, what does a balanced regulatory framework actually look like? This seems to be a trick question. And how is it different for startups, crypto-native companies versus incumbents? Because you're sort of in a unique position where you're, in a way, a crypto-native company, but you're owned by Standard Chartered. So you see both sides of the world.
No, absolutely. And it's interesting because for us, certainly, before we could even launch, we had to go through prudential regulatory approvals. We had to go through the kind of financial regulatory approvals. And I kind of agree and disagree to a certain extent with what Konstantinos was saying. The one consistency, I would say, on a global basis is probably AML, largely through FATF and the publication and how the standardization came about there. And frankly, anti-money laundering controls shouldn't be a surprise to anyone. It's not like they were invented yesterday, right? They're constantly evolving. But the one thing that we see, from my perspective, relatively consistently around the world is the global standards or the expectations. And certainly for a company that's backed by a global bank, we have to meet the highest standards of anywhere. And I 100% agree with Konstantinos. A lot of firms have probably tried to skirt those standards by setting up in jurisdictions where perhaps it's not as consistent and not as strictly enforced, and we've seen some of the outcome of that through criminal activity that I think has dragged this industry through the mud. The flip side of that is, from my perspective, you almost have to treat every location independently, and I'm sure Revolut has the same viewpoint, right? Which is, there isn't a global consistency, which means it inhibits global scale and adoption and true value accretion as it relates to cross-border movement and value. We do a lot in stable coins, and that's a very hot topic at the moment. And in particular, when you've got the European Union that has got MiCA and a very broad, comprehensive framework, but quite restrictive, particularly on what they call systemically important stable coins, which I think is the whole point of them, by the way. They should be big and they should be able to scale. Then you've got, I think the Genius Act in the US was first pass was yesterday. I think the vote got through yesterday. And so that's a huge kind of landmark because it really brings the dollar-backed stablecoins, which are the most prevalent, into a kind of a bit of regulatory clarity. I wouldn't say certainty, but a bit of clarity. But every market around the world has dealt quite differently, and the challenge is about harmonization. The challenge is how do you then, Revolut is a much bigger business than ours, right? But how do you manage that in a framework whereby you don't want to inadvertently get things wrong? And that's where innovation is hampered because you have to be very considered, which is important because you're dealing with potentially consumers. But for a wholesale business like ourselves, we try and deal with people that should know what they're doing. But if they don't have any clarity around the rules, it becomes very difficult for them to even get involved and for true global adoption to really take place.
Anatoly, from your vantage point as an investor, but also someone who raises capital from other sort of investors, are there any regulatory gaps that would make it easier for you to do what you do?
Well, fundamentally, we are in a business of making sure the market is efficient by virtue of our being across different liquidity pools, different exchanges, kind of trading venues. So interestingly enough, the business is extremely global. Whilst the firm is based in London, we're trading across 24 time zones in a business which never stops per se, right, including Christmas night. So from that perspective, the business is global. The client base, whilst it originally was the UK, ultimately expanded into Switzerland, Middle East, and the US. And the US is one of the largest kind of provider of capital to this business. So from that perspective, there is no limitation per se. Some of the jurisdictions are more open to that. Some are more closed. Some of them are maybe concerned that as part of your business, you hold certain crypto assets, which may be outside the legitimate, whatever kind of number of assets, not called securities and so on, right? Although a business like ours will not really hold anything. Most of the transactions would be sub 1 second. So from that perspective, your holding time horizon is very short, if any. So I'm kind of seeing interest emerging from around the world, even more so. US is now driving this regulatory change, as we just mentioned, and that makes many other jurisdictions comfortable following US lead. Because however you look, US is still the global trendsetter, including crypto.
Lucy, have you seen sort of companies adapt the companies in your universe to this fragmentation and these changes and the potential for, just a few years ago, or not a few years ago, a year ago, the US was a no-no and some countries in Asia were better and everybody was picking, let's go to Dubai. Yeah. So how do you manage a smaller business when you're trying to understand where to go or invest in one?
Well, it's interesting. Any companies that I'm looking at that have founders that have American citizenship are suddenly not American, don't live in America, not doing a crypto business in America. And that was just a few years ago. And now they're so excited because they're like, we're American, we're part of this sort of, American tokens, Trump loves us, and we're going to build and move teams over to America and expand offices. And I'm seeing every single startup, even at the very bottom of the scale, right, who are just starting to get ideas off the ground. The US is now part of their roadmap, it's a part of their strategy, and the implications of that sea change in focus for founders is going to be enormous. And it's great because sometimes you get questions, well, if the US is now moving into the crypto startup game, what about the other jurisdictions that have worked really hard over the last sort of 5-6 years to get frameworks in place, get ahead? UAE is one of them. But Malta, Gibraltar, and then Hong Kong, Singapore, these jurisdictions have worked really hard, and now sort of America's coming in. But actually, it's all going to complement the landscape. It's great that America's joining because it's going to make all of these jurisdictions collectively stronger, and startups can have a more international approach to building out their strategy. I still think, to echo some of the other comments, there is still big differences between the way regulators are looking at the industry. Some haven't got off the starting blocks. Some want to sort of push it into existing securities regulations, and other regulators are saying, no, this new technology, this new asset requires new rules. And I think the US is actually open to that discussion. And that's going to be the really exciting piece of the outcome of this discussion of what a regulatory framework for crypto will actually look like, and how much will change, and how much will just be tweaking the existing securities rules that we have in place.
Konstantinos, do you think it is likely that we will get more global coordination on crypto? Or are you guys operating from a perspective that that's not likely to happen anytime soon?
Not anytime soon, from my perspective. As Usman said, we still haven't gotten any clarity on stablecoins, which effectively is a very simple store of value and potentially a means of payment. And even there is still a long way to go. We have different approach in the EU. The UK is considering its own approach now, and it seems that they're taking yet a different view from that in the EU, and obviously we have the US taking a completely different approach.
I actually disagree. Stablecoin is not store of value. It's mean of paying for sure, but not store of value, right?
Well, in emerging markets, it's a store of value. If your currency is depreciating by 90%
Against
a year.
Exactly.
And that's exactly my point, that even on that, there's still quite a bit of a gap between the approach different jurisdictions are taking.
I think the truly innovation would have been if Genius Act would allow stable coins to be an interest-bearing kind of instrument. And that's something which US is adamantly against, right? Because it would resemble narrow banking, whereby you as a financial institution, you do not engage in a speculative activity. You are not taking liquidity transformation. You are kind of just holding a US dollar liquidity. But that's something which Federal Reserve System is very uncomfortable if you are suddenly passing interest rate, because that's going to deprive banking system from the deposit base. People are going to move into stable coins, not only as a mean of payment, but also as a store of value and interest-bearing structure.
I mean, but that's also fundamentally an inhibitor to innovation, because essentially what we've got is incumbent protection.
Yep.
So the regulators are enabling protecting the incumbents in the ecosystem, whereas actually with the underlying technology, the ability to disintermediate and use distributed ledger properly allows for some of that thinking to evolve. But essentially what we're doing is we're bridging kind of an existing framework, exactly as Lucy described, securities regulation and the way things have been done for nearly 100 years, right, with an evolution in that space, against a technology that actually allows you to really move forward at pace. Absolutely. Right? And so this is the real balance. I mean, this is a theme of this, this topic that we're talking about. It's trying to find that balance and go, I 100% agree with you. The innovative approach to allow for stable coins, which I agree are super simple, to pave the way, but then protect the incumbents in the ecosystem.
Yeah.
I mean, I don't think Nokia or Kodak were protected when they failed to innovate and essentially have largely gone out of business, right? So that kind of fair market balance isn't really there in this space because of, I think, a lot of lobbying and a lot of protectionism.
But I would hope... Sorry,
but the stablecoin issuers are now trying to get banking licenses. They're trying to be the next generation of banks. So, it's really in the hands of lawmakers now as to whether they allow this shift and how they manage it, because... we've seen this in China as well with the digital yuan issuance. It has to go through the banking network. They can't risk disintermediating these financial giants. It would just be too unstable in the short term. But that's not to say that over a longer term, we're going to get changing of the guard of who banking partners are and what a bank account looks like. I mean, we're fast moving to bank accounts being digital wallets. And
we have an example here.
Exactly.
So, Usman, you mentioned Mika briefly. You said it was a bit restrictive on stablecoins. I remember before it was passed, there was much cheering because at least something was passing, and it's a very comprehensive framework. So now that it's been implemented, what are sort of the lessons learned? Is it too restrictive? Like, is it a good model perhaps for the UK since they're still a bit behind?
Yeah, I mean, the UK, I think, is behind. I mean, the consultations are coming out now. I think the challenge around... from my perspective around Mika is by essentially locking out some of the biggest and most liquid tokens out there at the moment, it means that the European Union has made it harder for people in the European Union to actually adopt. There's some protectionism. I think Mika was born out of the Facebook experiment around Libra and a reaction to that. And so, but that kind of died in 2019, right? So you're on a backward-looking basis, it's taken 6 years to kind of get there, and the world's moved on. I think for me, there was a lot of cheer because it was the first kind of comprehensive framework across a major set of jurisdictions. I think the European Union is a multitude of different countries. But I think there needs to be an evolution and an adaptation to how the world is looking to adapt. And I mean, I was just going to touch upon Konstantinos' earlier point and again, agree completely around lack of global harmonization. But if I look at regular traditional finance trading, there is not consistent global regulation there either. However, there's regulatory equivalence, right? There's passporting and regulatory equivalence, which allows for a degree of certainty to say, okay, if I'm operating in the UK or in the US, under the laws of the UK and the US or whatever it might be, then broadly speaking, other top-tier regulators will say, actually, we're comfortable with the framework within which you're operating, therefore we'll allow you to operate on a cross-border basis. One of the benefits of what we're talking about here is the ability to do things cross-border, and we've got a geopolitical landscape at the moment that is probably thinking more about barriers. If I think about trade barriers as an example as being one, and it's, again, finding that bridge and that balance.
So you mentioned traditional markets and traditional regulation. So Anatoly, one of my favorite topics is always market structure. And I'm curious to see whether this market sort of adapts to traditional market structure a bit because there are some structures that make sense or the other way around. So after FTX, sort of as a fund, what were some of the things that you sort of wanted to see implemented to make sure that the structure of the market looked a bit safer for someone? Because let's not forget, lots of funds failed, they lost their money all of a sudden because they trusted the exchange, which was acting as a custodian, holding their collateral, lending money, which is not really common in other markets.
Absolutely right. So in crypto, there is a thesis, be your own bank, i.e. hold crypto with you controlling private keys and custody of your own assets. It may work on the personal level, but certainly doesn't work on the institutional level. Specifically when you're in a fiduciary asset management, capital has to be kept by third-party professional custodians. Now, in a pre-FTX world, there were no proper custodians like we have finally now. In a pre-FTX world, many exchanges would hold clients' assets, in addition to being a matching engine, which exchange is supposed to be. And these two functions should never have been under one roof. Now, FTX revealed the weakness of this structure, and essentially the whole market moved beyond this inappropriate holding of clients' assets by the exchange in favor of segregation of these duties. So the structure which is in place today, people like ourselves, professional players in the field, would hold capital with third-party custodians like Zodia and others, whilst exchanges would mirror this capital. Say my 100 million sitting with the custodian would be seen by the exchange, and exchange would allow me to trade within this 100 million as my margin without me physically moving capital to the exchange. And this is something which resembles perfectly traditional asset management and traditional market structures. Whenever non-crypto asset manager trades on NASDAQ, capital never sits on NASDAQ. It would be with BNI Mellon, JP Morgan, or State Street as major custodians, while exchange only exercise its very narrow function, matching engine. So crypto in that regard moves exactly towards traditional market, and this is appropriate structure. You have to segregate risks. So I'm very glad to see this became now a norm, and any major exchange would follow these rules.
Usman, I think this is perfect for you since you also have a sister custodian. But what do you think? Like, if everybody always talks about institutions coming in crypto, right? So what do they need? Do they
Anatoly set me up perfectly here as well because
that wasn't staged.
It wasn't staged. I'll pay him later. But ultimately, when we looked at our business and when we were launching our business, we were absolutely adamant And I remember talking to Anatoly and his team early on about that segregation of duties. We set up Zodia Markets as an independent trading function separate to a custodian, because actually in my previous firm, I ended up introducing a regulated custodian, which was insured, et cetera, but I told my board that this should not be a function that sits under the same legal entity structure. It was because there wasn't the ability to actually enforce that because the regulatory frameworks didn't exist when crypto started. That segregation of duties is critically important, and it was really manifested, and just for history, we launched our business about, as it happens, about 8 weeks before FTX, but in the year prior, we were talking to regulators, in particular in the UK, where their response to me going through a crypto asset application was, well, no, we've not seen this before. We normally see in the crypto landscape all the functions under one roof, and to the point where I had to prove that we were not outsourcing our responsibilities under anti-money laundering to a custodian. And I was going, but you've seen this in traditional assets for 50 years. I mean, this is not new. They're doing their job. They need to manage the assets. We're going to execute and transact on behalf of our clients, not hold the assets for them. As a business, we've adopted or opted in to client asset segregation rules, as Anatoly describes, because they're not a mandatory requirement under the regulatory frameworks at the moment, because, as I talked about, the UK is very much an anti-money laundering framework, not a regulatory framework. So businesses like ours have taken the steps to say, actually, we're just going to apply the principles from regulation, from standard regulation, that we think make sense. Yep. Segregation of client assets is just basic and fundamental, and we had businesses prior to FTX saying, oh, you're going to make life more difficult, can't you just move the assets for me, da-da-da-da-da. Let's call them slightly less professional than nickel digital assets, right? To literally the week after FTX, people calling us up going, yeah, you kind of got the right business model here. You kind of got this right. I'm like, yeah, but now no one wants to do anything because FTX has just blown confidence because of criminal activity.
Yeah. And we're seeing regulation now taking it one step further and managing conflicts of interest as well, because FTX obviously had major conflicts of interest trading on its own platform with, well, client assets, of course, but it's all intertwined.
Lucy, we mentioned, sorry, going off script a little bit, because we brought up stablecoins. I think we cannot have a panel today without talking about stablecoins a bit more. But maybe for the audience, can you just briefly say why there's such excitement about stablecoins? Because they've been around for quite a while. We mentioned Libra. There was Tether even before. But what's all the buzz and excitement now?
Yeah, so stablecoins, effectively fiat money, essentially on blockchains, is kind of the final piece of this crypto puzzle. It really completes the entire trading cycle. So as we're seeing more and more real-world assets get issued and traded on blockchains, and we've got players like BlackRock, Franklin Templeton leading in this, tokenizing treasuries. You need that cash leg of the trade to also settle on blockchains. So it's enormous, sort of completing the transition to move finance onto blockchains. But more than that, they're really fundamental, because by putting, for example, US dollar-backed stablecoins on chain, you're driving new demand for the collateral that backs those stablecoins. And so, for example, now, stablecoin issuers like Tether are not regulated. They comply with AML rules. They're not regulated. But each US dollar is supposed to be backed by short-term US Treasury debt or fiat money, US dollars in bank accounts. And because stablecoins are getting into the hands of new participants in a global economy, so people that do not have US bank accounts could not get a US bank account if they tried. Corporations, parts of Latin America, they are now having access to stablecoins, but they're driving new demand for the collateral that's backing those stablecoins, which is short-term debt, US government debt, and demand for the US dollar. And at a time when there's deglobalization, de-dollarization, I would say triggered by some rhetoric from Trump in 2025, it's been pretty spectacular. And this kind of mass exodus away from US-backed assets and the currency itself. it's interesting that they can drive new pools of demand for US dollar-backed assets through stablecoins. And it's being taken up, and it's growing very, very fast. And you've got stablecoin issuers that are now in the top 20 of the largest holders of US debt. So when China's sort of dumping their US treasuries and sort of getting back at Trump, don't worry, because the man on the street in South America wants those US dollar-backed stablecoins. And so this demand is becoming decentralized for US dollar debt through stablecoins. So it's a really interesting shift that's underway.
There's also kind of an example from my weekend payment for supposedly a civilized country. It was a summer camp in the US for my kids, which is, without naming university, Ivy League University. Payment accompanied by 4.25 surcharge for the debit card processing. And I was like, pause for a second. 4%, that's your annual yield, right, kind of on US treasuries being stripped in a matter of seconds. And I was like, this is insane. It's a supposedly civilized banking system still operating on these very old, archaic rails of overcharging their clients. And of course, stable coins can process these payments in a fraction of a second, kind of not only a fraction of a second, fraction of 1 cent in theory, right? So it's literally kind of we require this new technology to penetrate our life and substitute what we've been living through this kind of hellish banking system for the last many, many years.
So Konstantinos, to bring it back to sort of the original topic, right? We've heard about one crypto innovation. As a business, right? How easy is it to say, you know, Revolut users, you can now pay with Tether or Circle across the world and send money with that, right? At the moment, could that be done? Because in theory, you could, right? Just from wallet to wallet. But in practice, what's not making it possible?
I think it goes back to what we discussed about earlier, regulatory alignment and global standards of regulation, because there could very well be perimeter issues around engaging in this sort of activity. We already enable payments with stable coins, and we have products that allow for this, but it's still an area that is very fast-paced and moving, and there's no global consensus on what that might look like in the near future.
One more, Usman, on stablecoins, and I promise we'll move on. But you know, there's been lots of new entrants. We also reported Revolut was planning on a stablecoin. PayPal launched one a few years ago, but no one's really been able to make a dent. And Tether continues to grow. They're based in El Salvador. It's not clear whether the regulation in the US would apply to them. Do you think in maybe 1 year or two we will see what, if the Genius Act passes, someone else actually get into the market or break their dominance?
I think that's going to be tough. And the reason I think it's going to be tough is adoption. So from a utilization perspective, I think if my numbers are right, Tether's at about $140 billion market cap.
151 is it this
151,
morning?
well, there you go. Sorry, my numbers were wrong. But Circle's at 60 something. Sorry. So between the two of them, you've got $210 billion out of, I think, $220 billion of total stablecoin assets. And I've had this conversation repeatedly because we're heavily involved in the ecosystem. But the challenge there is, it's not so much, is there going to be someone new? Is there a framework that will allow Tether and Circle to operate in a more, I don't know, legitimized global landscape? And that's less so about Circle, more so about Tether. Because ultimately, it's already been adopted. Now, you know, we've got a researcher at Standard Chartered who has written about, by 2028, he sees the stablecoin market cap moving from $230 billion to north of $2 trillion.
Makes sense.
Right? That's a 10x increase in the next 3 years, right? Which is an incredible adoption rate. I don't see a bank-issued stablecoin or a government-issued stablecoin coming in and taking that. I see that being adoption and utilization because that's what's already happened. People around the world are already utilizing this new form of digital money, predominantly in the dollar. I mean, I'd love to see more non-dollar stablecoins and think about how that would impact the de-dollarization angle or the global trade angle, right? Because one of the challenges is still, and I think we've all kind of alluded to it, you have to then still get back into the current banking system. You know, again, I'm not going to plug our business, but a little bit about where we are is that we bridge the current banking system with a majority-backed backing of Standard Chartered and the digital asset economy. And so the ability to move funds incredibly quickly has been a massive enabler for us, in particular in markets where waiting for the dollar markets to open or dollar clearing to open, maybe that's between Asia and the Middle East, for example. In this region, waiting another 7 hours for the US markets to open, or even earlier in Asia, that's 7 hours of capital that's not being utilized. And so it's really about capital efficiency, and the dynamic around capital efficiency is, I think, giving ownership back to the individuals, whether it's companies or individuals, and not essentially paying eye-watering rates, which 4% I think is actually not that uncommon. It's probably, as you say, in a Western economy, it's unfair, but if you look at sub-Saharan Africa and people remitting money to relatives, etc. I mean, Revolut do a phenomenal job, but they're not necessarily there yet fully. But people are paying 7 to 11%. For some of the poorest people in the world to move money around the world, I mean, that's criminal.
So, Lucy, to broaden the conversation even a little bit, as an investor, what are some of the areas you're excited about now? Like, has all the innovation arrived? It's
That's
very
really
broad.
name.
Yeah. So we don't talk too much about stablecoins, but I wonder, people might be thinking, so crypto's been around, like, what's coming across your desk? Are there new things that might be coming in crypto, or is it time to take a breath, like get the stuff that's there to actually work?
I mean, there's obviously that, hopefully startups continue to build through the ups and downs and through the cycles. But I think, what's interesting that's coming up is really the merging of crypto markets and traditional finance markets, and use cases at that intersection is finally having its moment, which plays very well to my background because I'm, ex-TradFi, ex-Goldman, ex-Credit Suisse, all these things. And it's so exciting to see global banks get on the front foot. Sounds very boring, but, HSBC, Goldman, they've all been given the green light. The US administration has effectively said, get in the game. Now, secretly, they've been working and innovating behind the scenes, but now they're able to come out and they're sort of spinning off and incubating startups like, Standard Chartered is doing with Zodia markets. They were actually a first mover. But I think we're going to see a lot more of these types of startups, and that's very exciting because they can really change the game. If they're backed by big names, big institutions now, by the big banks, because institutional money can now flow into crypto. So I've been in the crypto space 8 years. Very hard. The market actually is not big enough to absorb institutional-sized checks. You can't sort of put 100 million into a deal. They just kind of don't exist. And I expect that to change in the coming years. I think the funds are going to get bigger, the space is going to get bigger, and the impact of the startups is really going to start to meaningfully disrupt the existing financial system and the way that we do business. So that's very much on the finance stroke crypto side that I'm very excited about. But obviously there's grassroots innovation happening across other different verticals within crypto. Crypto is not limited to finance, although people do want to make money typically from their tokens. But this idea of sort of empowering individuals through tokens and through decentralized blockchains to really give rise to new use cases, whether it's through social media or monetizing your social media content, basic theme of cutting out intermediaries, and that can be in art, that can be in social media, that can be in music, lots of different ways where if that business has a blockchain underpinning the business model, it changes the dynamic and it changes the way individuals can monetize data and be incentivized to produce data. So it's really across the board, I do focus on the broad spectrum, but the finance piece I think is going to be very pertinent this year and next.
Do we have any questions? Because we have 4 minutes left. One there, yeah.
For private institutions and states. So states in the United States are getting in on this game and they want to start socking away Bitcoin at least. So is there a killer app or white space in your different worlds of exchanges, custodians, venture capitalists, and banks that someone could kind of start going down the rabbit hole of? Or to your point, Anna, is all the innovation kind of at steady state and now people are just creating features and bugs, not really new products? Because it seems like FTX had its day in the sun, and the exchange story hasn't played out yet. The banking story certainly hasn't played out yet. So what do you think the next move will be for the industry?
I think you're getting at sort of innovation on the Bitcoin blockchain. Is that where you're focused on? Yeah.
If there was a next unicorn, what would it be?
Yeah, I mean, there is a lot of focus on trying to make Bitcoin a yield-bearing asset. It's kind of digital gold, and it's sort of inherited that narrative. But like gold, there's no yield on Bitcoin. But people want to find ways to derive yield on their Bitcoin holdings because increasingly it's becoming a bigger chunk and percentage of an overall asset allocation. So how do you make that work harder for you? And the wonderful thing about crypto and tokens and blockchains is that you can program use cases on top of a base asset. There are risks, which we're not going to go into for this question, but there are ways to get yield on your Bitcoin. So that's definitely a core area of experimentation and innovation for the space.
Does anyone else want to?
Can't top that answer.
Any more questions?
But I think in terms of innovations, we mentioned startups, which kind of driving this kind of change in landscape. But I think that major institutions from traditional space will become far more active in this space, right? The reason being, for a long time, their ability to engage was heavily restrained by the regulatory framework. And coming back to Goldman, GS launched Digital Asset Desk in 2018, 7 years ago. And until recently, there was internal evolution of different ideas.
They couldn't do anything with it.
But they cannot do anything, right? Exactly. And it's to the frustration of Goldman themselves, right? There are 70 people in digital asset division, but kind of what they can potentially do is very limited. Now, with the changes coming, I think they're going to be challenging. Kind of finally, this ability to impact the market will be there, which actually may challenge the dominance of Tether. Tether today is undisputed leader, exactly as you said, and the first mover advantage helps. And it's today, whatever, 60% of the market share. I think if we were on this stage 2 years from now, this share going to be lower. Because this is such a kind of interesting business, stablecoin on its own.
We'll hold you to it. In 2 years, we'll see if Tether's still come back here.
Tether's still going to be around.
Yeah, we have to check. Take notes.
But major institutions going to be claiming market share in stablecoin business.
All the banks, all the US banks will issue a stablecoin.
That with, for example, Binance had a huge dominance in the market, over 70%, and now that is decreasing gradually.
Last thought, Usman. What are you excited about?
Well, the other thing I was going to just touch upon, we talked about startups, but you've now also got clarity for the major participants in the ecosystem. I mean, just in the last month, we've heard about M&A transactions probably totaling, what, north of $5-6 billion, just in the digital asset ecosystem, right? So, Coinbase buying Deribit for nearly $3 billion. I mean, that's the biggest kind of pure crypto M&A deal that there's been.
Stripe buying Bridge.
Stripe buying Bridge last year. Again, the stablecoin angle again. You were not going to come back to it, but we got there again, right? But part of this is it's growing up. It's consolidation. It's it's consistency. I mean, frankly, the fact that Ripple, Coinbase, and others are no longer sat there fighting the SEC, right? Being in lawsuits means that they've been able to deploy capital and think about how to grow and scale the ecosystem and create more, hopefully, path for startups and scale-up businesses to evolve and grow. But there will be consolidation, and it's going to make this space incredibly exciting to watch.
All right, ending on a positive note. Thank you so much.
Thank you.
Thank you.